Today, we will look at range and deviation market bias confirmations and liquidity basics. In the first part, we will focus on premium and discount bias. Then we will learn the importance of stop-loss hunting in the ranges. In the final section, we'll talk about what kind of strategies that we can use within the ranges. We have so much to do. If you're ready, let's start. Welcome our free trading course, all about price action trading strategies and smart money concepts. If you love scalping and day trading and looking for range and deviation strategies, check out my free course. You can find the links on Google Drive or directly from my website, which is in the description. And please try to watch videos in order, otherwise it can be really confusing. Okay friends, as you know, last week we covered the range part 1, the basics. We talked about what are ranges, what happens before and after ranges, why prices are ranging. More importantly, we learned how to draw and identify them. I made it crystal clear how to draw a range. Check that video if you are still having a confusion. This week, before moving into strategies, I would like to talk about range bias and how we can use it to our advantage. So finding trading setups will become much easier when we have a range and market bias. As you know, ranges consist of two major external parts, premium and discount. Once a range is identified, our job becomes 10 times easier because when we look for trading setups, we'll have much clearer market bias and trade direction. Basically, we can look for shorts from the range high deviation or directly from the range high zone. If we miss opportunities, we can check out overall premium zone for a trade setup to short the asset in the direction of discount. For the discount area, it is exactly the same. Once the price is in the range low deviation, we look for a long trade setup. Furthermore, we may also wait for trade setups to form around range low or in the discount zone. Ranges give us these clear biases to trade, a trade direction. If you follow me on Twitter, I traded this range many times. I do not even count the numbers anymore. This was a very clear range to identify. Again, I will not repeat how to identify ranges. Please see the range part 1 if you missed it. Let's observe this range. Once you use your path tool and hide candlesticks, everything becomes much clearer. You start to see that how the price keeps reacting to the range high, range low, and EQ point. Sometimes I think that ranges are magic because they work very well and gives you extreme market bias and trading opportunities. You can clearly see how the range high and its deviations push the price to the range low. And the range low and its deviations keep pushing the price to the range high. This is a critical part of confirming ranges. You may ask how all these happen and why prices range 70% of the time in the markets, up and down continuously. The easy answer is liquidity. If you analyze any range, you'll notice this. Once the price starts to move from range high to range low, there will be so much liquidity forming. And with a proper trade setup and entry, all these stop losses will be hunted. It is same with range low to range high movement. Price will start to form liquidity areas to be hunted. With a proper trading setup and entry, all this liquidity will be hunted when the time is right. Probably the most important element of trading ranges are liquidity. Basically stop loss hunting of retail, or I would like to say beginner traders. In general terms, we are all retail traders. Let's watch it closely. Liquidity forms, and it is hunted from range low to high. Liquidity gathering, and it is hunted from range high to range low. Another stop loss gathering. It is hunted from range low to premium zone. It again creates stop loss area, being hunted to range low. Then another liquidity area forms, and it is hunted from range high to low. Now I'll stop talking for a while, you guys keep watching it. As you can see what ranges do actually keep hunting liquidity and stop losses between range high and low. You will also need to check mega liquidity areas happening at the top and the bottom of the range. As you can see, these mega stop loss zones are also hunted with proper trading setups. So what is the lesson here? The lesson is quite simple. Watch the liquidity forming in premium and discount zones and wait for a proper trading setup to form to enter a trade. As you know, ranges consist of four main parts: range low, range high, EQ, and the deviations. Now, with the help of forming liquidity and imbalance zones, range high and range low will be natural price magnets. They will pull the price to themselves. Another very natural magnet area will be the EQ. Price will always be drawn to EQ point and rejected or rest in the EQ for a while. These three zones are very critical price levels and have an essential part in our trading setups. Another big characteristic of ranges is the importance of EQ points. It is extremely important for me. Plays a huge role in our trading setups. Once you draw the movements inside the ranges from high to low or low to high with the path tool, you'll witness that most of the time price rests at the EQ zone. In this example, you can clearly see that each time the price moves from range high to low or range low to high, the price rests or rejected at the EQ point. It sometimes has a quick break and sometimes hanging a lot. At other times, EQ could be very powerful and rejecting the price altogether. EQ will play a very important role when we make decisions for entries and targets in the future. So, when we form a trade game plan or setup, we have mostly three options: carrying a position from range high or its deviation to the EQ point, or positions from range high or its deviation to range low point, or small positions from premium to discount. It will be exactly the same with long positions, carrying a position from range low or its deviation to the EQ point, or positions from range low or its deviation to range high point, or small position from discount to premium. As you can see, ranges will give us a market bias and trade direction to trade. In some cases, if you are a scalper, you'll probably love the ranges. Once you identify a range, you will have a very clear gameplay area, just like GPX and VWAP trading. For example, once you identify the range in 1 hour or 4 hours as your high time frames, you may use smaller time frames like 15 minutes, 5 minutes, or 1 minute as your low time frames. You can find hundreds of small scalping opportunities from range high to low or range low to high, all depending on you. Now, as for strategies, I'll cover the most specific internal and external strategies next week. Sorry for the delay, but I had to teach you range basics and range bias first before trading specific strategies. However, in the meantime, you have already learned over 20 entry models in our free trading course. Once you identify a range, you already have a market bias and direction to trade. You can basically use any trading setup inside or outside the range. So you can look for order block trading setups, breaker blocks, swing failure based trading setups are one of my favorites, optimal trade entries or reverse optimal trade entries, power of 3, support resistance flips, rally based rally, drop based drop, mitigation blocks, any trading setup that you love. You already know all these trading setups. Now, with this video, we completed range basics and range bias. Next week, I will work on specific internal range strategies. And the other week, we will focus on external range strategies. Finally, I'll complete the range series with real trading examples and trading practices. Okay folks, we completed part 2 here, ranges and market bias. These are very important supply and demand strategies used by day traders and scalpers. I believe that it will be really helpful in your trading life. I hope you subscribe to the channel and like the video. Thank you, please take care and see you soon.